All right, let's dive into First Merchants Corp, ticker FRME. They just dropped their Q4 2025 numbers, and on the surface, it looks like a solid beat. But, the market's reaction, well, that tells a way more interesting story. So let's break it all down.
First up, the bottom line. First Merchants came in with a clean beat on earnings per share. They reported 99 cents, which was a good 3 cents ahead of what Wall Street was expecting.
And it wasn't just earnings. They backed it up on the top line too. Revenue came in at over $178 million, beating expectations by more than $5 million. So yeah, looking at just the headline numbers, a pretty solid quarter.
Okay, so here's where it gets really interesting, right? You have to look past those big headline beats. Check out that loan growth, a really robust 7.3% for the year. I mean, in this kind of environment, that's a fantastic sign. It tells you the bank's core engine is running strong. They're out there successfully lending money. And you combine that with a rock-solid CET1 capital ratio of 11.7%, and, well, the key takeaway here is that the underlying business looks really healthy, super well capitalized.
So a strong quarter is great, but as any investor knows, the real question is always, what's next, right? So let's get into management's playbook. They laid out a pretty confident game plan for 2026. Let's take a look at the guidance.
And yeah, they're definitely guiding for another strong year. They're targeting 6 to 8% loan growth, which basically means they expect to keep this current momentum going. Plus, they're forecasting a very healthy 10% bump in non-interest income. And they keep talking about operating leverage, which is just a fancy way of saying they're focused on making sure revenues grow faster than their costs. All in all, this is a really confident outlook from the top.
But let's be real here. This quarter wasn't just about these standalone numbers. No way. The entire story for FRME right now, the thing everyone is watching, it all revolves around one single thing. This massive, massive integration of their latest acquisition.
And this is their plan, laid out pretty clearly. Management was super direct about the strategy for bringing First Savings Financial into the fold. Step 1, they're going to sell off about $250 million of First Savings bond portfolio, basically cleaning up the balance sheet. Step 2, they're targeting some really aggressive cost savings. We're talking 27.5%. And Step 3, and listen up, because this is the key part for shareholders, they plan to do all of this without raising any more capital. So see, this isn't just a simple merger. It's a very specific, engineered plan designed to create real value.
So, let's recap. You've got a clean beat on earnings and revenue. You've got strong guidance for the year ahead. And you have this crystal clear plan for a huge acquisition. You'd think the stock would just pop, right? Well, let's see what actually happened.
Yeah, the market pretty much just shrugged. The stock opened up less than 1% on the morning of the call. I mean, think about that. Despite all this good news from management, there was just no real buying pressure. The reaction was incredibly muted, a total non-event.
And this right here is what creates such a fascinating disconnect. You've got management on the call talking up a record year and robust growth, but the market is basically responding with, yeah, we know, that's already priced in. Management is projecting all this confidence, but investors, they are clearly in wait-and-see mode. It's obvious they're looking right past this solid quarter and are laser-focused on one thing, the execution risk of that big First Savings deal.
And if you want to understand why the market is so skeptical, you just have to zoom out and look at the bigger picture. Over the last year, FRME stock is actually down 3.35%. Meanwhile, the regional bank ETF KRE is up almost 19%, so the stock has been a major underperformer. It makes sense then that investors are demanding more than just one good quarter. They want to see stone-cold proof that this massive acquisition is actually going to pay off and finally close that performance gap.
Okay, so let's put this all together. What we have is a solid core business that's being completely overshadowed by this huge looming integration. So what does that mean for next quarter? And more importantly, where does the stock go from here?
The next earnings report is going to be all about one word: execution. We absolutely need to see the first real data points on that integration. Are those cost savings starting to show up? Did they actually sell that bond portfolio like they said they would? We'll also be watching to see if that loan growth momentum is still there. And, probably most critically, we're going to see the first real impact of the deal on their net interest margin since it closed on February 1st. These are the exact proof points the market is sitting back and waiting for.
So with all that in mind, our rating for the next call is market perform. Look, the company is doing a good job with its core business, that's clear.
But the stock feels fairly valued right here, at least until management can prove it can pull off this first savings integration and deliver on those promised synergies. The potential upside is definitely there, but it's completely tied to execution. Right now, the risk and reward feel pretty balanced, which tells us it's probably going to perform in line with its peers until we get a lot more clarity.
And just as a final reminder, this is not financial advice. Everything we've discussed today is for educational purposes only.